Hi, this is Steve Rising with the Trading Institute. We're going to pick up from our previous video where we discussed the beginning stages of the 3 steps of trading. Step 1, identifying which condition we have on the daily chart, range-bound condition, which is the more prevalent condition, or momentum-based condition, which is the less prevalent. In other words, 80% of the time market's trading sideways, 20% of the time we've got momentum-based activity. So picking up there, after we've determined that range, we then start to create our trading plan, and then step 2, we then look for our entry strategy to develop in relationship to that trading plan. Now here at the Trading Institute we teach 2 specific entry strategies, and it's important to understand that entry strategy is critical to the trading process. And in fact, it's why when people try to attempt to trade what we discuss in just these free videos, they're not successful with it, is because they don't have a solid entry strategy. But critical criteria for entry strategy is 1, entry strategy has to be black and white, and 2, it has to get you in at what's known as the beginning of a price move, because then it allows us to use a much tighter stop. So here at this point we have price here trading at a significant number, which is part of strategy number 7, and then our entry strategy develops right here, and now it's based on a specific candlestick that we're looking for. But let me clarify here. We use a Japanese candlestick chart simply because it's easy on our eyes. In our trading methodology and with the strategies that we teach, we do not use any Japanese candlestick patterning whatsoever. The entry candlestick that we're looking for meets our very specific criteria. But the key is it has to be black and white. In fact, I interact with individuals all the time who use oscillator-based entry strategies where we're looking for indicators to hook over or cross over or identify a potential entry point. And you can poll 5 people trading the same trading the same oscillator-based entry strategy, and you'll find that they all have 5 different versions of where the entry can be. And that's the trouble trading oscillators or indicators, is they're very complex. There's a lot of subtle nuances to them, and most people can't trade them consistently. And so trading needs to be as black and white a process as possible. So step 2 for us is entry strategy, and here we have one of our entry strategies developed. We have an entry strategy that we use when trading strategies 1 and 2, and we also have a second entry strategy that we teach when trading strategies 3, 4, and 5. Then step 3 comes into play, and it's profit target. Now it's interesting, most people don't even have a solid exit strategy. And the reality is we teach a form of scalping here at the Trading Institute. Now by pure definition, a scalper is somebody who's going in looking for small fractional moves in the marketplace, and they're trading repeatedly throughout the day. That's not what we do. We use the spirit of the term scalping, and the reason for that is the majority of Forex brokers do not allow that style of trading. But we use the spirit of the term scalping where we go for a fixed profit objective. We typically look for a net 10 pip profit objective. That's the average size move that we look for. On occasion we'll go for 15 or 20. We work off of a 10 pip stop. We work off of trading ratios of 1 to 1, 1 to 1.5, or 1 to 2, where we're willing to risk $1 to make up to $2. But the reason why we use a scalping approach, well, there's actually a couple of reasons. The primary reason is it's statistically shown that an individual who has a predetermined profit target prior to a trade will make 10 times more money than the individual who tries to ride a move. The individual will make 10 times more money over a 5-year period than the individual who rides the move. And the reason why we do this in Forex is we know that price has some very specific characteristics of where it will stop or stall at specific numbers. We also know that the directional bias is consistently changing. 1 candlestick we're bullish, 2 candlesticks later we're bearish, or vice versa. And so we go in and we scalp a portion of a planned move. The reason being is the way we grow our account in a positive direction is we simply become more consistent in the trading process, and we then begin to add more lots. In other words, off of this particular move, a 1-lot transaction would have netted us out $100. A 5-lot transaction would have netted out $500. It's a common principle that's been in trading for decades. In other words, what's easier, to buy 1 share of stock and wait for it to move $100, or to buy 100 shares of stock and wait for it to move $1 to achieve the same $100 profit objective? And this is where people get into trouble trading the Forex market, is they try to find and attempt to trade big moves, but what happens is price stops or stalls or slows or stalls and then reverses on them because the directional bias is constantly shifting, as discussed in step 1. So please review that video if you haven't seen it yet. But the key here is really market conditions discern what size profit target we can go for. You know, there's an old saying in trading, if you're looking to hit the home run all the time, you're going to strike out a lot as well. So we can forecast where a price should slow or stall, and then our objective, once again, is to just scalp a piece of that move. Because we're also safer and have a higher probability of longevity the less time that we're in the market. So on occasion, market will open up. For instance, when we had the last half of last year, when the bailout activity started to be announced, Forex market was a fantastic market to trade. The moves, the average size of the moves were much bigger, and we were able to capitalize on some consistent 30 and 50 pip trades. But those conditions have dried up. We're back to standard FX conditions where we scalp typically 10, 15 to 20 pips based on market conditions. There's another age-old saying in trading, you're never going to know where the top or the bottom is until after it happens. So once again, we use the spirit of the term scalping where we go for a fixed profit objective. But the key here is, remember, in step 3, we want to have a predetermined profit target, because once again, it's statistically shown that individuals who have a predetermined profit target will earn 10 times more than individuals who try to ride it out and wait to see if they can get some additional pips. So based on step 1, we identify which condition we have, range bound or momentum. Then step 2, we apply which strategy relates to that condition and plug that strategy in, create a trading plan, and then wait for one of our 2 entry strategies to develop, and then we go for a scalped plan profit objective of anywhere to 10 to 20 pips based on market conditions. So once again, if you didn't have a chance to watch that first video, please do so. I'm Steve Rising with the Trading Institute. I encourage you to attend one of our free online trading seminars where you can watch and listen to this information applied into a real-time market to learn more about our trading methodology and the training program that we offer here at the Trading Institute. Thanks for viewing.